I hope it's going to be an interesting 1 hour full of new information, or maybe information that you already know presented differently. What we are planning to do with this presentation is to familiarize you with the long-term incentive plans. So basically, you don't need to know anything about it. You're going to learn a lot today. If you already know how this type of mechanisms work, I still hope the presentation is going to be interesting for you, because we have some, let's say, new additions to bring to this topic. Hopefully, that's what we hope to do. I'll not go through the content. We'll start with the general aspects and what is the, let's say, why do we talk about long-term incentive plans? The main objective is to recognize and reward employees, typically in key positions like management role or specialists, people who are very important to your company, and those who have a role with developing the company. It is also important to motivate and retain them, and it's, in our opinion, even more important now with all this flexibility and work from home, and as employees start to become more flexible with their day-to-day activities, they're also looking for remuneration mechanisms that reflect this flexibility. Another objective can be aligning the performance of bonuses with the company's the performance bonuses, sorry, with the company's financial results, basically paying bonuses depending on the results and not fixed amounts, because that's typically what happens. Access to the management shareholding structure for private equity structures, but I don't think there are any here. We have what is called the skin in the game, basically making the management get involved in the underlying entity. You can improve the cash flow of bonus payments, and of course, most of the time you can optimize the taxation, because income from capital is generally taxed on more favorable terms than labor income. We see it very often in the IT&C sector, in the financial sector, and in large multinational groups. Lately, it has become quite used in startups as well. We see an increased interest in this type of plan because it's flexible and it's easy to mold on any type of business model. And it's also used for regulatory reasons like the CRD directive or MiFID and so on. The most common forms of long-term incentive plans or employee participation plans, these words, let's say employee participation plan, long-term incentive plan, they all mean the same. It's basically a mechanism, a long-term mechanism to incentivize the employees through cash payments or share payments. That's, in a few words, what this means. And we see stock settlement plans. So basically you pay them in shares, in stock. And here we have a stock option plan, restricted share units, share acquisition plan, and cash settlement plans, phantom shares, stock appreciation rights, phantom stock option plan. Just to give one example, I'm not going to go into too much detail here. For example, a stock option plan is basically when you give the employees options to acquire shares at a future date with a predefined price. So basically you can choose the price of your share today. You will grant them an option to acquire the share in 3 years with the price of today. This means that any increase in the share will be their own gain. Let's call it like that. In share acquisition plans, it's basically when they acquire shares, and with every share they acquire, they receive a free share. What we see typically is for every 3 shares acquired, they receive 1 free share. And that makes them, incentivizes them to gain access to the management, to the shareholding structure, basically. How does a long-term incentive plan work? We have typically 5 important moments. We have the grant date. It is the date on which the employee is granted the right. And here we discuss either about an option, which is a financial instrument in itself, or under the form of a promise. You promise the employee that something will happen in the future. to receive free of charge or to purchase equity shares with or without fulfilling certain conditions. At the same time, the acquisition of shares can be replaced by the payment of a cash amount, which represents the increase in value of the share. And these are the share plan, the cash settlement plans. When you pay them in equity in shares, we call them the share settlement plans. We have the grant moment, so this is basically when you give them the promise or the option. We have the vesting period, or how the Americans like to call it, the cliff. It is a period in which the value of what you granted them increases. It is also the time, or decreases, of course, if you're unlucky. At the same time, it is the period in which the conditions or the restrictions that you put in the plan at the moment of the grant must be fulfilled. Restrictions such as you need to be employed for this period of time, the company needs to have had X% of increase during this period, and so on. So it's basically a period of blocking. The employee cannot exercise his promise. The exercise date is the date on which the employee becomes the owner of the shares, or the date on which he receives the cash bonus. Here is when he exercises his right to receive what you promised in the grant, and that he waited for so long during the vesting period. This is typically where cash settlement plans end. Why? Because at the exercise date, you pay them the cash amount and that's it. It's finished. There are also some plans that have a clawback period, meaning that if he did something wrong in the past, for example, he has committed fraud, but serious offenses are not just small things, you can take the cash settlement back, but only for important matters. When we have share settlement plans, we have two other moments. It is the holding period. So for share settlement plans, at the grant date, he receives an option. The option to acquire something in the future. You have the vesting period in which that promise, let's call it that, is blocked. He needs to wait to see what happens if the shares increase or if his conditions are met. Then you have the exercise date. He uses the initial promise to receive shares, and here he received shares. And then you have the holding period. This is the period when he holds the shares and acts as an investor, basically receives dividends, can sell them. He's a normal private investor in the company. And then you have the selling date, the fifth important moment. It is the moment when he decides to sell the equity that you provided him with in the exercise, at the exercise date. This is the general aspect. This is how this type of plans work. What about Romania? How can we do something like that in Romania? In Romania, it's easy. We can basically separate all the plans into two. We have the stock option plan, which is defined by the Romanian tax code, and we have everything else. What we call it is qualifying stock option plan and non-qualifying stock option plan. If it doesn't qualify based on the conditions of the tax code, it's in the other part of the plans. So the definition of the Romanian tax code provides that a stock option plan is a program initiated within a legal entity, granting its employees, administrator, and/or directors, or to the employees, administrators, and/or directors of its affiliated entities, the right to purchase at a preferential price or to receive free of charge a fixed number of shares issued by that respective entity. To qualify as a stock option plan, the program must include a minimum period of 1 year between the moment of grant and the moment of exercise, when the shares are purchased. Let's take this definition and split it into different conditions, let's say, that the plan needs to meet in order to qualify as a stock option plan. First, what we see is that we have conditions related to the beneficiaries. So So they need to be employees, administrators, and or directors of the company, so of your entity, or employees, administrators, and or director of its affiliated entities. Why? Because most of the stock option plans that we saw, this definition exists in the tax code since 2016. And at that time, most of the definitions that we saw, most of the stock option plans that we saw were implemented by the group or implemented somewhere else, not in Romania. And they were just rolled over to the Romanian entity. Employees of the Romanian entity were receiving options or shares in the group company. And at that time, it was discussed with the Ministry of Finance to allow also affiliated entities into the definitions. What's we also said affiliated entities. What's an affiliation? Is the holding directly or indirectly of at least 25% of the value or number of shares or voting rights of the other legal entity or control. It is also when a third entity directly or indirectly holds 25% of shares in both entities or controls them both. So what this means is that we cannot give stock option plan to contractors, to independent freelancers, yeah, because it would not fall within this definition. The second condition is the right to purchase or to receive free of charge. And yeah, this one is quite easy to understand. You need to give them the right to purchase or to receive free of charge. An important discussion that we have here when analyzing stock option plan is what happens with those plans where the employees receive only the economic rights and not all the rights, including the legal rights. There are some plans where, for example, you have the right to receive the shares, you have the right to receive the dividends, but you don't have the right to sell, you don't have the right to vote, you don't have the right to borrow. So basically you will receive something, but you cannot do anything to control an eventual downside because you're blocked by the conditions of the plan to do so. And this is an open question, if it can be considered that you receive the right to purchase or receive free of charge a participation title, share basically, or whatever financial instrument, when you get only economic rights over that asset, over that financial instrument. We're not going to get into that right now. It's just a question that you need to ask yourself if you're planning to implement this type of thing. The third condition is free of charge or at a price lower than the market price. And here, we're not discussing about plans where the employer provides financing alternatives for acquiring the shares. So basically, if you grant a payment in installment, a loan, it's not a stock option plan. It's not taxable either, because if you acquire the shares at the market price, at the date and place of granting, it's not a benefit in kind based on the provisions of the Romanian law. So we're not talking about the stock option plan, but we're not talking about the benefit in kind. A fixed number of participation titles. So you should receive a fixed number of shares. Not fractional rights, so you cannot receive 0.26 shares. You cannot receive illimited number of shares, yeah, so which are basically correlated with your performance or with whatever else. And we're only talking about share settlement plans. At the end, you cannot give the employees a cash payment. You need to go through a share settlement scheme in order to qualify as a stock option plan under the Romanian law. And there is also a minimum vesting period, which is of 1 year between the moment of grant and the moment of exercise. There are also some plans which have special exercise or early exercise, how we call it, in case of change of control. So if you, for example, the company is sold, if you have a liquidity event, if the company, for example, decides to become a public entity and does an IPO. We also have early exercise in case of disability of the employee, death of the employee, of course, and retirement. Why am I saying that you need to pay special attention? Because this can happen during the 1-year minimum vesting period, and this can disqualify the plan from the beneficial favorable tax treatment provided by the tax law. And we'll get to that in a second. What are the advantages of the qualifying stock option plan? Well, the tax treatment. At grant, it is non-taxable. So the employees receiving the options or the promise will not have to pay any income tax and social security contributions. When they exercise their right and receive the shares, it's non-taxable. It doesn't matter if they pay something for the shares or not. When they sell the shares that they receive through the plan, you have a 10% income tax computed on the difference between the sale price and the price paid, which is going to be zero if the shares were granted free of charge. And under certain conditions, you also have the health insurance contribution in a fixed amount. For 2021, the fixed health insurance contribution for income other than salary income. Here we talk about freelancing, agricultural, rent, investment. So for everything accumulated is 2,760 RON, which is approximately 500 euros, 500 and something euros. The dividend taxation, so when during the holding period, they act as investors, so they can receive dividends. Dividend taxation in Romania is subject to 5% income tax, and under certain conditions, the same ones that we discussed before, the health insurance contribution in a fixed amount, which is 2,760. It's important to mention that this amount of health insurance, the 2,760, it's applicable to all the income that you receive other than salary income. So when you receive rent, dividends, and capital gains, you add everything up in a bucket, let's call it like that. And if you obtain more than 27,600 RON per year, you pay this 10% of 27,600 RON per year, and that's it. So you're not going to pay the 2,760 for each type of income you obtain. Not going to pay for dividends separately than capital gains. Everything all together. As disadvantages, as I said in the beginning, it cannot be implemented for cash settlement plans, and it cannot be implemented to reward the growth of profitable standalone business lines. Imagine a company that has 2, 3 type of business lines, and one of them is new and is growing very fast because the market really needs it. But the other 2 are declining because, yeah, it's what happens in business. If you do this type of qualifying stock option plan, you would not be able to give your employees of this profitable standalone business line the result that they need, because when evaluating your company, it's going to take into account the declining state of the 2 other businesses. So it's not going to grow as fast as that standalone business line would. Another disadvantage is that it's impossible to control the selling price paid. Why? Because you cannot put a cap on the value of the market. So if you have an extremely good year and your business grows fantastically, you're going to pay more than what maybe you have budgeted in the beginning. I also said it cannot be implemented for independent collaborators, so I will skip this. I also said that there are questions where you give only the economic rights and not the legal rights, so not important. And quite inflexible for a performance-based remuneration tool. This is my opinion on the matter. It should be, in order to work to its fullest extent and to what it has been designed to do, it should be way more flexible than what it is at this stage. And I will pass the mic to Raluca to give us some corporate aspects on stock option plans.
So I'm going to start, let's say, in a negative context, these disadvantages, but from a different perspective, from corporate perspective. So Claudiu mentioned some points which, from a fiscal point of view, maybe make you second thought the idea of implementing a stock option plan. From a corporate point of view, the following should be maybe considered. First of all, what kind of structure should we choose in order to implement such a stock option plan? Can it be a limited liability company, or should it be a stock option company? The disadvantages reside mainly or derive mainly from the general context of a limited liability company. First of all, such a company cannot hold its own shares, which means that in the beginning, when you decide to when the step is to sell the shares, to transfer them to the employee, the question is, how do you do this? A joint stock company can do this. A joint stock company can hold its shares in a percentages of maximum 10%, and can use them to distribute them to the employees. And this is basically a provision in the Romanian company law. It's regulated, it's allowed, and so on. A limited liability company does not have this possibility. So what can you do here? You can either bring the employees in as shareholders via a share increase capital, which is not an option in case you offer the shares for free, which is an option that Claudiu mentioned, because in that situation, the employee pays nothing. So there is nothing to contribute to the share capital of the company. The other option would be to create an affiliate, which could be a mother company, another limited liability company, or a company which is controlled by, let's say, the target who would implement the stock option plan and who would be financed totally or partially with the shares of the first limited liability company. So from this perspective, it's not impossible to implement a stock option plan with a limited liability company, but it's a bit more complicated. Next, a limited liability company cannot have more than 50 associates, more than 50 shareholders, unlike a joint stock company, which has no limits for such a number of participants. In case you want to extend this stock option plan to a large number of employees and you want to have it, let's say, as a long-term incentive instrument, it is possible that this maximum number of shareholders limits you and basically blocks the aim and the purpose for which you decided to implement it. So this could be also a restriction, which does not apply in case of a joint stock company. Then, in any case, if you do an increase of share capital, if you do a share assignment in order to get the employees as shareholders in the structure in which you want to implement the stock option plan, there is an issue related to the fact that in a limited liability company, each modification of the incorporation deed must be registered with the trade registry. So imagine if you extend this plan to tens of employees, how you would basically have a whole department going to the trade registry and keeping up with all this modification. It would be, let's say, impossible, if not impossible, at least crazy to put in place such a plan. Again, if you intend to extend the stock option plan to a large number of employees. This restriction does not apply, again, to joint stock companies, which, as we know, can be listed on trade markets, can be open stock joint stock companies. They have a completely different regime from a corporate perspective. Also, Claudiu mentioned before the idea of giving the employees only the economic, let's say, rights related to the shares, so no voting rights. Of course, there are the fiscal questions that Claudiu mentioned before, but again, if you consider this option, you cannot have it within a limited liability company, because in a limited liability company, all the shareholders have the right to vote. Only the joint stock companies basically allow the shareholders to hold shares which can receive dividends but cannot exercise the voting rights. the limits of these, let's say, special participations that can be held within a joint stock company are aligned, to say, because a joint stock company can have 25% of its shares as shares without voting rights, and 10% can be distributed to the employees. So basically, since 10% is less than 25%, you can have 10% of the shares without voting rights, and that can be distributed with the employees. This is something that can, let's say, ground a decision to change maybe the structure of your company from a limited liability company to a joint stock company before implementing employee incentive plan. The good news in all this is that it's not a complicated procedure. Changing the form of the company from a limited liability company to a joint stock company, it's quite easy. It's a registration with the trade registry. All in all, it takes, let's say, 1 week to 10 days, maybe, with all the preparation of docs and so on. So when putting on paper the advantages and disadvantages, you should also consider as an important, let's say, bullet point there, the structure in which you want to implement the respective plan. Now, moving forward from the corporate discussions, there are also some implications that should be considered maybe from a labor legislation perspective. And the discussion which is, let's say, fashionable these days, and which I've heard put even in, let's say, extreme contexts, is the one regarding discrimination. Is an option, a stock option plan or incentive or employee incentive plan, is it discriminatory to allow the access to such a plan only to some of the employees? Do we have to open such an option to all the employees of the company in order not to be in a situation of, I don't know, having a discriminatory treatment? What is actually discrimination? Does the employer still have the right to organize its activity, to set its bonus, its motivation systems, to decide on the basis of its economical results, of the opportunity, of what he thinks that it's best for his business? Or he just must be anytime cautious that in case some employees have access to some rights and some others do not, he might be sanctioned for being in a discriminatory position? And because I've heard this discussion in a very general context, I think it's important to point out that there are clear legal provisions on this. We are talking about a provision in the labor code, which was modified last year. It's Article 5, so that if you want to check it, it's quite straightforward. So discrimination means that you decide to grant some employees some rights, and to some other employees you don't grant the same rights, for reasons related to race, citizenship, ethnicity, color, language, religion, and so on and so forth. So based on subjective criteria, on criteria that are strictly related to the respective person. On the other hand, if, again, and I'm coming back to the first slide and to the first ideas that Claudiu shared, given that the scope of a stock option plan is to motivate your employees and to keep maybe the key employees in your company, and to align the results of the company with the bonuses that maybe you do not want to give access to everybody, because this is, let's say, a criteria which is strictly connected to the performance and to the motivation you want to give to the employees. All of these, if you open a stock option plan for all these kind of criteria, in my opinion, it's not discrimination. So basically, if you allow access to such a plan on criteria related to results obtained in the previous year, involvement in achieving the objective of the company, moral, professional, and social conduct, and so on and so forth. So basically, objective criteria again, but still which allow a separation and which do not include everybody in the company in such an option, this would not be a discrimination case. Again, another issue to be considered, and this is a technical issue, but it's still to be put on the list. It's about how you draft the papers around the stock option plan, because, for example, if you decide to grant the participation against a small, maybe an economical value, if the employee has to pay something, maybe it's easier for you to, let's say, withhold the respective payment from the salary of the respective employee, so that you don't have a back and forth for a small amount of money or not a considerable amount of money between you and the employee. And in this condition, in this case, we again must pay attention to the provision of the labor code, which forbid the direct retention from the salary unless you organize it in a form in which the employee actually empowers the employer to use part of his salary to pay the respective shares. So there is a part of documentation which must be drafted in a way not to position ourselves in an infringement or to the limits of the provisions of the labor code. So this was from me, Claudiu, back to you.
Thank you, Raluca. So just to sum up a bit, the qualifying stock option plan, I will just go back to this slide. If these disadvantages here are, let's say, not a big deal for you, the advantages are great. And let's say it's worth analyzing the qualifying stock option plan. Now, let's say the disadvantages are quite complicated and we don't want to change into a SA, and we want to implement it only for a standalone business line, or we don't want to pay shares, we want to pay cash. What can we do? And this is the second part of the presentation. And it all started with these disadvantages. We were thinking of how can we make this more flexible? How can we allow people to access to have participation in the profits of the company or in the growth of the company, to be more precise, without all these problems that we identified in the first slide. Well, and of course, we came up with something which is called another type of participation plan, because there's no definition to it in the tax code. The disadvantage of this is that since it does not meet the criteria, of course, the market value of the options or the cash bonus will be considered salary income. If it's a salary income, it's subject to 10% tax and 37.25% social contributions. So it's a big disadvantage because you need to pay a lot. And our question then was, what can we do to reduce this taxation? Because if we manage to reduce this taxation, then the disadvantage maybe doesn't become such an issue. And so we can use the advantages of being more flexible and avoid all the problems that we identified before. And so we came up to this, what we call now a phantom stock option plan. It's called like this because it works like a stock option plan, but it's phantom. It doesn't pay in shares, it pays in cash. But the cash payment is computed the same as if we would use shares. And the idea is to give an option to the employee. The option is a financial instrument that allows them to acquire shares in a future date. Here, they're not going to acquire shares, but they're going to receive a bonus, a cash payment, which is the difference between the market value of the shares at the time of exercise and the market value of the shares at the time of granting. Yeah. If you would do a stock option plan like this, you would give options. They would pay the acquisition price at the exercise date, meaning the employees would need to pay the value of the shares as computed at the grant date, and they would receive the shares. Then they can sell the shares in the same day and receive the value, the market price at the exercise date. Here, we're not using shares at all because we don't want to go to the trade registry and have an entire department doing this, like Raluca said. So we're just going directly through the cash payment. We said that we're giving options. These options are financial instruments. If they're financial instruments, it means that they also have a market value. of themselves. So you can basically say how much an option is worth. And this is determined using valuation methods, such as Black and Scholes, Monte Carlo, and some others. And here in BDO, we have a specialized team that assess options, basically. At the time, as obtaining the bonus is a possibility and not a certainty, the market value of the option is reduced by introducing limits and restrictions. And here is what we said in the disadvantages section of the qualifying stock option plan. Here you can put caps. You can say, I will provide you with a cash payment, but up to a certain amount. I'm not going to go above that. I'm only going to do it if you are, let's say, an employee of my company until that date. I'm only going to do it if the value of the share increases with at least 10% per year. All of this you can do. And all these restrictions that you put in the options will limit their market value. Yeah, because valuating an option means assessing the possibility of receiving that gain. Yeah. And the more restrictive, of course, the lower the value. From a tax point of view, a benefit in kind is valued at the market price at the date and place of granting. So when the employee is sure to receive the benefit in kind. It's not when you promise something to him, but when he's sure to receive something. So in order to consider that the benefit in kind is the option and not the cash payment, the option that is provided to the employee needs to be unconditioned by the employment or contracting relationship between the issuing company and the beneficiary, and to have a market value. That's the only criteria. It has to be unconditioned, meaning that it has to be in his patrimony, and he should have the right to do whatever he wants with it. He can sell it, he can pledge it, he can exercise it if he wants, he can leave it to lapse if he doesn't want to exercise it, but it has to be his own choice. Good. So if we do this and we make it unconditional, then the value of the benefit in kind is the value of the option and not the value of the cash payment. Good. So it sounds like this can limit a bit the taxation. Good. We're also thinking, yes, but if you give options to employees and they're, it's in their patrimony, is this maybe, am I a financial institution issuing securities or not? And here we had a letter from the National Bank of Romania saying that if it's only limited and only for an employee plan, and if you basically make sure that they don't start circulating to the entire market, there's no obligation to register as a financial institution. What you can also do, because of course your employees are not expecting a bonus in 3 years from now when the shares will grow, they are expecting a bonus now, is to provide them with an interest-free loan. The interest-free loan, based on the Romanian tax code, is not considered a taxable benefit in kind as long as the employee repays the principal. So it's only this difference between the market value of the interest and zero, in this case, is not going to be considered a benefit in kind. Of course, if he doesn't pay the loan back, the principal amount, the main amount, then it is a benefit in kind. So what you can do is to grant an interest-free loan to finance a part of the bonus, waiting for the shares to grow. Another thing is that for this type of plan, so we said, if you give it unconditionally, the value of the option is the benefit in kind. When you give a benefit in kind, you need to tax it at that point, which means that you are going to pay tax without knowing what's going to happen 3 years down the line. Because let's say you're hoping to have a growth, but maybe you're going to have a loss. And if you have a loss, there's no point in exercising the option, because as I said, when you exercise the option, you receive a cash payment, which is computed as the difference between the market value then and the market value now. if the market value then is lower than the market value now, you're going to have a, let's say, a negative amount of bonus. And of course, that option will not be exercised. But you already pay tax, because you pay tax on the value of the options. So now your loss is even worse. And this is important to have in mind. I don't want to, let's say, frighten you, but what I wanted to do is come down to this slide, which is the questions that we have the most, the frequently asked questions with this type of plans. And people usually ask, the first questions that they ask is, what is the biggest risk? And the biggest risk is not to have growth. If you don't have growth, you promise something to the employees. You promise that they will receive a bonus. Potentially, it depends how you communicate with them. They're not going to have anything, and they already paid tax. So this is the idea. But if you're certain that you're going to have a growth in the next period, so in the next 3 years, for example, or you're certain that a standalone business line of yours is going to grow, then it may make sense for you. Other questions that we receive: is there a tax risk? Well, there is always a tax risk when we don't have a definition in the tax code, because as I mentioned here, what we use to basically to explain this tax treatment is the definition of the benefit in kind. In the tax code, we have the taxation of the benefit in kind is at the moment when the benefit is granted to the employee. If the tax authorities consider that the option is not in their patrimony and that you have the right to take it back at any time, it means that it's a mere promise, and the promise is not a tax. The issuance of a promise is not a taxable moment. The taxable moment is when he receives his benefit. But if you make it as, let's say, if you structure it properly, this risk can be controlled, so it can be minimized. Of course, if you start to put all type of restrictions in the plan, and well, if you leave within the vesting period, you need to give me all the options back, and you're not going to receive anything, then of course there is a risk. So I think the answer to the question, is there a tax risk, is it depends on how you structure it, and you need to pay attention on how you set the rules to your plan in order to not have this tax risk. How do I control my bonus cost? You can say, for example, that the selling price, so for example, that the cash payment is computed as the difference between the market value of the share at the exercise moment, capped at X amount. And that's going to be taken into account when you value the options. It's going to lower the value of your options. And in case something happens, so in case you have an extreme increase of your business that you were not hoping, at least you control the cash bonuses. You don't start paying more than you were budgeting. You can also put conditions based on which you only pay a bonus if the annual growth rate is 6%. What if the value of the shares is lower at exercise than at granting, and I promise the employees that I will pay them a bonus? This is what I was discussing before. It means that in addition to implementing the plan, you need to pay them the bonus, and you need to pay the tax on the bonus. So it's going to be an even bigger cost for you. Can I grant options that reflect the performance of a single department? Yes, you can, as long as you can value them. So they need to be standalone businesses. They need to have their own, let's say, assets, their own liabilities, so on. And now I will go into the example because we have 10 minutes left. I just want to show you 3 different calculations. One for a typical cash payment, a typical bonus payment in cash. The second one, a qualifying stock option plan. And the third one, this phantom stock option plan, just to see how it looks for the total cost of the company and for the net income of the employee. And here, so we have a company that wants to implement an LTIP with a vesting period of 3 years. At the time of implementation, the market value of a share is 100 RON. The option can be exercised only if at the time of the exercise, the value of the share increases by at least 3% per year, considered to be a minimum increase expected for the industry in which this company operates. So it doesn't want to pay any bonus if the company works, if the company grows as the industry would suggest. It wants to pay something if it goes above this, which makes sense. Employee A receives 100 options. On the exercise date, the employee will receive a cash bonus representing the difference between the market value of the share at the time of the exercise, capped at 150% of the initial value of the share. This is the capping that we discussed before. And the strike price, the value of the share increased with the minimum expected increase. The value of the option is 15% of the strike price. So this professional evaluation team has valued the option, and they say, look, it's 15% of this price that the employee would have to pay in order to exercise his share. This is the strike price. It's the price to pay when exercising your option. The actual growth rate over the 3-year period is 15% per year. What is the total cost and net income obtained by the employee in the 3 scenarios: payment of a cash bonus, stock option plan, and phantom stock option plan? And the figures are this. And I will try to explain them briefly so that you have an idea on how it is computed. But at the executive summary is that the net income received by the employee, if you pay them a cash bonus, judging by all the things we said in the example, is that he will get 2,504.67 RON. Net in hand. After paying all the taxes, he can do whatever he wants with that. For a qualifying stock option plan, the net payment is 3,853 RON. So a substantial increase. For a phantom stock option plan, the mechanism that we described before, it's 2,985. It's not as good as a stock option plan, but it's better than paying a cash bonus. In this example, of course. The total cost incurred by the company for the cash bonus is 4,378. The stock option plan, 4,281. And the phantom stock option plan is 4,072. And why is the difference? The difference is because here we are controlling our fair market value at exercise. As you see, it's the 3, 4, 5, 6, it's here. The fair market value at exercise for a cash bonus is 152 per share. Here, the same thing. While here, we have 150 because we capped it. So here we said it's going to be capped at 150% of the initial value of the share. Yeah. So here you can control your costs, basically. What my conclusions are from this table, let's say, is that when you have the ability to implement a qualifying stock option plan, do it. It's better. As you can see, the employee has a better return on his, let's say, a better net income in pocket, and the cost is okay. The net income per cost ratio is very good in a qualifying stock option. When you cannot implement a stock option plan because the group would not allow you to change the structure into a SA, or it doesn't allow you to do another SRL in Romania, or whatever the reason may be, it may be interesting to consider this, the phantom stock option plan, because as you can see, the net income is a bit higher and the cost is controlled, and you can accurately determine it. And that's all from me. I think that's all from you, Raluca, as well, right? Do you have any questions now?
Yes, actually we do. First of all, thank you for the presentation to both of you. Allow me to read what we received on the chat.
Sure.
So it's not necessarily a question, but your opinion would be valued. I have recently received an official answer to a question filed with the Ministry of Finance on the SOPs, the stock option plans. While the officials have acknowledged that irrespective of the name of the program, as long as the definition is met, the favorable tax treatment may be enjoyed. According to their response, if we have a mixed plan, for example, vesting lower than 1 year or higher than 1 year, under the same umbrella plan, both programs will not qualify as the definition is not fully satisfied. From my point of view, the interpretation is abusive. What is below 1 year shall be taxed as a benefit in kind, BIK, while the one higher than 1 year, not. So your opinion on this?
Very interesting. It's a very interesting thing.
It is.
Yeah, and we also had the same. We also had the same discussion with some of our clients. Because indeed there are plans which have step vesting. You vest initially after 6 months, and then after 1 year, and then after 1 year and a half. And the question was, the initial vesting, okay, it's under 1 year, we understand, it's taxable, it's fine. What happens with the subsequent vestings? Because they're under the same plan, and the definition of a stock option plan refers to the plan, not to each step of the way. And I say that they have arguments to consider that the entire plan doesn't qualify based on the definition, but it would indeed be, let's say, not incorrect, but it's not what everybody was hoping to hear. Because the plan, I mean, if you split it, if you just take the first vesting out of it and do 2 different plans, then the second plan would meet all the conditions. Why would the first plan not? Why would this not qualify? But unfortunately, they are right, and this is something that you need to consider. It's one of those questions that I don't like answering because I understand the frustration, but I also understand the technicalities of the answer of the Romanian tax authorities, because they just look at the definition. They say, look, a stock option plan is a plan initiated by a company. If it doesn't mean that condition, it means that the whole plan is non-qualifying plan.
And if I may add something, if you get, let's say, not favorable ruling during a control fiscal inspection, namely if they qualify it as benefit in kind in whole, and if you go to court, I'm afraid that the tax authority's position has good chances to be kept, because as Claudiu mentioned, the premises, the grounds, all the conditions of the plan are unitary. It's an entire document. It's one plan. So probably the court will go with the same interpretation as ANAF does, as the tax inspector does, because this idea of artificially splitting some transaction in order to get a favorable tax treatment for part of it, it's sensitive, let's say, to courts also, and they can interpret it as let's say, an artificial way to try to get a better fiscal treatment for part of the same plan.
Our participant follows up with grossed up benefit in kind or taxed as such?
Well, it depends how the plan is structured. If you provide the employees with a net benefit, you need to gross it up. If they are the ones who should bear the tax and social security cost, then you can just tax it as such. What most people do in this type of plans where they become taxable in Romania is that they do a sell to cover. And it's also important to discuss about this, because when you do a sell to cover, it means that you are paying a portion of your options in cash and not in shares, which means that it disqualifies the plan. So we get to the same idea. That's why I was saying in the beginning that it's very inflexible for a remuneration tool that is considered to, let's say, recognize your key employees. So I would read through the plan documents to see, because usually they have a tax and social security section, and there it's usually mentioned if what happens in case that the plan becomes taxable in one of the countries, because I assume this is a plan implemented by a group which is rolled over to all the entities in that group. And usually you should have a section there, and there you should see what's going to happen with the options if they become taxable in Romania. If you need to gross it up, or if you need to withhold from the other remuneration of the employee.
All right, thank you for your explanation, and I hope that was satisfactory, Elena.
If not, we can have an in-depth call if Elena wants.
This was actually my next remark. If, dear participants, you think of anything you'd like to have clarified after we close the webinar, just drop a line to us at info@nrcc.ro, and we'll put you in contact with BDO, with Claudiu and Raluca, and you can have all your questions answered. We don't have any other questions at this moment, so unless you two would like to add something, I suggest we close the webinar. I suspect that the presentation was clear enough for everybody participating.
I certainly hope so, and I want to thank everybody for taking the time and for their attention. And I really hope that what I said in the beginning was delivered, let's say, and that everybody had something to learn, something to understand maybe from this presentation. This is really what I wanted to do, and I really hope it matched up with the expectations.
Thank you, BDO Romania. Thank you, Claudiu, Anița, and Raluca, Andrei. And again, a big thank you to you all for joining us today. Don't forget, tomorrow we have the closing webinar of this NRCC Taxation Week. We'll be talking with Pekiev FinConta about transfer pricing, an overview of the OECD guidance on COVID-19. And also, for those of you who happen to be in Cluj tomorrow evening, we'll have an in-person event, namely the NRCC dinner. So you'll find all the details on that on our Facebook page. Just check there for time and venue. Wishing you all a great day. I look forward to see you all back here tomorrow for the close of this taxation week. Bye-bye. Take care.
Bye-bye. Thank you, everyone.
Bye-bye.